Good evening, ladies and gentlemen. Today is the 11th of June, and after a phenomenal performance by US markets last night, we opened with positive sentiment all around. Rapidly saw a lot of bullish data being built up by shorting of at the money and in the money, deep in the money puts all the way to 16,000. So data was looking extremely bullish, but once again, when we're at an all-time high and you're seeing so many new bullish positions being added, you should be cautious. My initial view was slightly contra, but the thing about being in a non-directional strategy and having like a partly directional view is that in case you're wrong, you have to get out of it fast. Otherwise, you will not be able to manage it. So initially, it looked like there was going to be a lot of upside, so had to balance that in between. Exactly as one thought, all the longs that built up got unwound at once, and that led to quite a dip. So it was relatively a small range day, but could have been tricky on either side. And at one point, when I was in a profit and there was a slight IV slump, so it was basically at a point where put options had lost money and call options hadn't gained money, and that would reverse. Either the puts would gain the value back or the calls would increase. And I was in a situation where the potential up move or down move would hurt me regardless. So I used that as a criteria to exit. And towards the end, I took a overnight trade. So I've just gone over what is that overnight trade, how much of my capital have I allocated to it, what is the reason for it, and whatnot. So thank you so much for watching. I think today's video, if you look into detail, at one point I took additional credit into an IV spike, and towards the end I cut out of the entire position into an IV slump. You can sort of I think that can be something that is useful in someone's day-to-day trading. Thank you so much for watching. Have a great weekend, and I will catch you on Monday.
Want to meet like minded traders and discuss option strategies, adjustments, and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. The time is 9:07 and pre-market is just about to settle. We're settling at almost 15,800, so we are back to the all-time high situation. And my plan will be to enter a relatively delta negative strangle by selling the 15,900 call and 15,600 put. More or less because 15,600 has been the support zone from which we bounce back. And since we're at an all-time high and we have an overall green, the idea at the onset will be to have a relatively cautious view towards the downside. Now, if that goes wrong, then the view will have to be corrected by taking off the call side risk. But overall, that is my plan for the day. I'll keep you posted. Being a Friday, generally we can expect that if the current expected volatility is to play out, then we should be able to get a good amount of PK in OTM options. And if there's a good call side IV spike due to the gap up, then we might be able to get pretty good entry price on the 15,900 call, which should give us enough freedom to manage even if we have a continued up move through the rest of the day. I'll keep you posted. The time is 9:08. The time is 9:26. I initially tried entering the 15,600, 15,900 spread, but due to the continued up move as I was entering, I could notice that there was a continued up move on the 15,900 call, and decided instead to enter through the 15,950 and play it that way. Otherwise, it becomes too heavily directional, and I didn't want that to happen. So, regardless, right now this 350 point triangle is trading at 78, and the potential gain through the fall off in this triangle should be about 10 to 15 points. Right now, the way I look at it, the 15,800 short straddle is trading for 200. That gives an upside range of 16,000, which is a big psychological mark, not that easy to cross, and a downside range of 15,600. So our put is basically at the downside range of what the straddle is projecting, and our sold call is just slightly below the upside range. So Bank Nifty gapped up but is heading lower after that. Reliance has shown some strength to pull back to 2200, and IT is looking quite strong. So that's more or less the summary of where we stand. Since today is the first day of options when seriously they will start building open interest for the next expiry, I'll wait till around 10 o'clock, 10:30 to assess what is happening on the open interest front. We'll keep you posted. Time is 9:30, relatively delta neutral, slightly delta negative for about 30 points lower from here. But apart from that, since there's been a good IV based increase in call prices, where suddenly, I mean, this is the lifetime high, so will cool off in case there's a rejection. Okay, having to deal with a very peculiar IV spike where the puts are not losing any value, but the calls are gaining in value. This can actually work out to be in my advantage because the puts still have value, which means higher up puts still have value. So I've quickly moved up my puts to neutralize the trade at 15,825 because there is a lot of strength in IT, and Reliance is building volumes and heading higher, retesting Friday's high. So with that being the situation, in case there's a downside rejection, this call side IV spike will come down and the puts won't gain as much because the puts haven't lost much to begin with. Whereas in case we have a continued up move, at some point these puts will have to degrade. So into the IV spike, I've actually increased the credit taken so that when the IV eventually cools off, there should be an overall benefit to the position provided the IV cools off, which it has to, given it is a spike wherein the puts have not lost value despite the up move, which means something has to lose. That's more or less hypothesis. Since my potential gain for the day is about 10 to 15 points, my acceptable loss can only be about 7 to 8 points, 6 to 7 points. So we'll not be taking anything more than that through an IV spike. But yeah, for now, quite slightly in the negative, about 4.5, 5 points in the negative. Okay, so right now, IT is looking very strong. Bank Nifty continues to look sideways to weak from where it is. Reliance also showing some strength. What has happened is there has been a slight cool off in IV, which is why they've benefited almost 4 points from that. And what would have happened is if there was a continued up move, then the delta of this basically, since there's more premium in this put, there's more risk reward possible in this put, it would have protected us against further expansion of the call. And in case that didn't happen, then some of the call side premium would fall off. And now what has happened is both of them, slightly on the put side has lost value, and the call has also lost value. Basically, what happens is when there's a quick move, the guys who are taking in risk or placing a position saying the market is going to go down are not agreeing that the risk reward on that position has changed. Well, these guys can clearly see what's happening and like, okay, the risk is going up, we suddenly want more, and the demand for this is going up. Well, the demand for this is not necessarily coming down. It takes some time. It takes a few minutes for people to realize, okay, is this holding? Is this going to get a quick rejection? Whatnot. And that's what leads to the strangle in value growing overall when there isn't much of a move on the spot to begin with. The reason I entered with a bearish view was that I was expecting like an immediate rejection of 15,800, some kind of profit booking, but that didn't come. And since that didn't come, I had to very aggressively skip a strike and move straight up to 15,700. And that IV spike, because the puts didn't give up too much value, it gave me the opportunity to enter at a decent price. So yeah, time is 10 o'clock. Keep you posted. We are more or less delta neutral from here, and it will be managing more or less how I manage a delta neutral strangle. We'll keep you posted. Okay, so taking a look at some of the open interest, what is visible right now is a lot of 15,800 straddles for that 200 point credit that's available. Good support on the put side at 15,700, and right now maximum put side open interest is also 15,700. Call side, some amount of call action right now building at 15,900 and 16,000, and I would expect that into rises there will be more positions built up at 16,000 most likely, at least for this series. So Regardless, we've recovered from that IV spike. Now we once again headed lower to 15,800, but towards that point, if you see, as we dipped, that was actually used to increase put positions, which is, so we dipped almost to 15,800, but these didn't spike very much. Not the way you would expect it to. Considering that this trade actually has a negative delta, you would have thought that a down move would hurt, but no, because there's so much IV expansion that took place on the call side into the down move, actually benefited our mark to market. And right now as well, because of the relatively high IV, as long as we don't break below 15,800 on the downside, we won't really have a problem. So the time is 10:24, and we've just recovered from the IV spike. Okay, so from the looks of it, right now at 11:08, just as we have an upside break, there is a lot of uh, put shorts building up at 15,800 and 15,700. And in fact, puts are being shorted all the way in the money up till 16,000. So this seems to be a lot of bullish sentiment. Now, Bank Nifty is looking more or less weak. It's not extremely weak, taking support at yesterday's close levels, but relatively weak. IT is rocketing in the broader market as well. It's doing quite well. So right now, the way the market is positioned, it is positioned with a upside bias. So we'll retain this position as is for now. In case there seems to be a sell-off, then I'll have to get out quite quickly because of the kind of longs that have been built up intraday. They can also be pulled out just as quickly, and I don't want to sit in the wake of that. Okay, we're taking a dip below 15,800, and what I'm going to do now is roll down half of the calls to 15,900. And to do this, to protect against some kind of cascading sell-off. So I'm not completely neutralizing the trade at 15,800, but doing it partly so that a continued down move gives me enough time to react by moving the rest of the calls down and moving these puts potentially away. Doesn't seem like a massive unwinding. This seems like a dip that most likely will be used to sell put options. So not seeing any unwinding at this point. Not yet, at least. And that's not reflecting on the option chain. It'll take some time to reflect, but more or less expecting 15,800 to hold. And but at the same time, in case the kind of longs that have been built up, they start to get unwound, that can be quite damaging to the 15,700. So half the quantity of calls have been moved down. Now, in case we start heading higher, once again breaking the day's high, then these calls will have to be squared off and move back up to 15,950. If not, I'll keep the skew as is. So half of this position delta neutralizes at 15,800, the other half at 15,825. Right, so it's a slight bullish bias, but that's also the bias of the market, and hold it as is for now. Also, if you look at the 15,800 straddle, currently trading at about 195, 196, doesn't really give you too much of an expectation of a down move. Also, something to note, Bank Nifty is looking very weak and it's now hovering just above 35,000. So, potential break from 35,000 on Bank Nifty could lead to more downside, but IT is looking very, very, very strong. It's been trending up the entire day. So, it's a balancing act between the two on the Nifty, which is why we're holding sideways for now. Okay, we are heading lower and I don't want to sit on this, so what I will do is take off the risk on the puts and then on the calls as well. What I'll do now is take these calls and move them back to 15,950. That way it gives me more of, in case there's a reversal, I don't get burnt by that. And take off the puts also. Basically moving them to the boundaries of what the straddle pricing is suggesting. We came in closer to benefit from the cool off in IV. That happened. That is past us now. So get out of these calls. Okay. Have taken off the risk on the entire position, mostly because Bank Nifty is now looking to break 35,000 on the downside, and there are a lot of longs that are built up that might get taken off just as quickly. I'm not too worried on the downside, but at this point, it's no point staying so close to the spot in such a situation. So this gives us a good, we're more or less back to the initial position that I was sitting on. So okay, one more thing I should do, since once the fall eases off a little bit, just move the puts to 15,650, because right now I have a negative delta. Basically an up move will hurt me, even though I've risked off on the calls. I've risked off on the puts by 100 points, and I've risked off on the calls only by 50 points. So once we hold range for a while, we'll move. Okay, massive red candle across everything. So just big sell into all of Nifty and components at once, pulling us sharply below 15,800. What I've done is I've rolled down my calls from 15,950 to 15,900, and more or less the idea is if my mark to market heads lower by about 5 points, then I will just take the exit and not bother trading beyond that. The only way that happens is if we have a continued down move, and yeah, we'll keep you posted. Big expansion on the puts naturally due to this kind of a move. IV spike as well. So we'll keep you posted. So just taking a look at the OI, you can see that at one point this was almost 33 lakh. Out of that, all of that 9 lakh got unwound very quickly into the down move. And a lot of call shots built up at 15,800 and all levels above. So more or less, the summary so far is a lot of short straddles built up at 15,800. Roughly, you can say between 190 200 would be the average price. And we'll have to see how much of this gets carried. The majority of it will get carried. But yeah, initially there wasn't much strength on the call side, but yeah, a lot of calls built up after that. Downside rejection. For now, this triangle is semi dealing with the fact that there is an IV, relative IV increase. Despite the reversal after the dip, the puts are not losing as quickly as one would expect. So we'll just wait this out and keep a trailing stop loss, more or less. No more changes to be done from this position. Okay, so here's what I'm doing. Taking the exit. I'll go over why once I'm done exiting. Right now, there is an IV slump where, due to after making 3 red candles, we've made one big green candle. A lot of people who are long puts, their stop losses would have hit, and there has been a considerable fall off on the puts and has not been replicated by the calls. Now, one of two things will happen in such a situation: either the puts will gain back their value, or the calls will start to gain. And we are once again at that crux of 15,800. The thing is, once we break 15,800, there will be an immediate expansion on the calls from people short covering. Into the down move, a lot of shorts would have built up, and quickly they will get covered. So does this mean that this trade will not make money if I hold it for the rest of the day? Not necessarily. It will almost certainly has a higher probability of making me more money, but it will be difficult to manage in case that up move comes. So it's a trade-off between, so to compensate for that, I would have had to move up this 650 put to 15,700. But then once again, if we take a dip to the day's low, it throws me into a very, very bad position. Like, if you see what I mean, right? When I started exiting, of course, I can't exit my entire order at once. If I do, I'll mess myself up on pricing. When I started exiting, this was at 47, this was at 45. Now you see, so the net triangle itself has gained from the point at which I started exiting. So it was at 47 and 45. Now it is still at 47 and 46. So anyway, that was the idea behind exiting. It probably will make easily 5 to 10 points towards the end of the day. The reason I'm taking an exit is because it's at a crux where it can go either way. And with the kind of, I mean, it shows these days, twice we've seen back to back that we have a lot of put shots building up during the day and a quick unwinding leading to a dip. And at that point, you don't know if that dip is going to continue or stabilize. So it's just not very attractive, the trade, the way it is set up. What is my other option? My other option is to risk off and sell the 15,500 put, right, at 20 and sell the 16,000 put at 20. So that is an option I can consider, but I'm thinking instead of doing that, I will just take the exit, because in case there is a short covering move, this will gain a lot and will not be compensated by the put, because already the trade will be a delta negative trade to begin with. So I'll see if there's some kind of calendar that I can carry overnight, but apart from that, this should be it for the intraday trade. Just have to exit these hedges. Oh wow, major miss execution. Yeah, we'll keep you posted if I'm taking anything to carry overnight. Okay, I've just entered a trade and I'm going to carry forward. It's going to be a double calendar spread on Bank Nifty. And the main reason for this is because IVs are making record lows, and I'm expecting that to halt. I'm expecting that IV crash to at some point halt. And I'll just go over the trade. Basically, I've done this with 60 lots of Bank Nifty, and I've used about less than 10% of my margin available on a trade, because a trade like this is relatively risky, even though the max loss is defined because it is 1:1 hedging. So you see what I've done is I've shorted the 34,500 and 35,500 strangle for the coming week, and I have gone long in the same strangle for the monthly expiry. How does this trade benefit? This trade benefits because more or less we have enough credit, because the difference in weeks is only one, wherein our break even is 200 points below the sold strike and 200 points above the uh, call sold strike. And in case there's an increase in IV, which we will invariably see when there is a big move, especially on the downside, then this position benefits from that. This is a limited loss strategy and has a pretty high probability of profit. It's difficult to calculate. Sensible will not calculate probability of profit here because there are different expiries. So they can be, technically this trade can make unlimited profit. IV can go to infinity, theoretically speaking, in which case you will have benefited infinite times. But anyway, that's theory. More or less, this is a position such that yes, a big gap down or something shouldn't hurt me, and regardless of what happens, I'm not expecting this to take too much damage. Capital allocation also is appropriate. It's just 10% because I'm carrying it overnight, and I'm quite afraid of carrying things overnight. And of course, this max loss possibility also, right? It's ridiculous. We'll need a 10% down. It's not impossible, but quite unlikely. So, and of course, this will come with an increase in IV also. So difficult to calculate all this in a calendar spread. I will keep you posted. I have a video coming out tomorrow on some of my favorite books and why I like them. So please do check that out if you have the time. Thank you so much for watching. Have a great weekend. Get some rest, and I will catch you.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram, and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.